Welcome back to Financial Pro YouTube channel, everyone. Today we're going to talk about growth stock investing. There are several strategies that investors can apply in the stock market to make money. One such strategy is purchasing growth stock shares. These are companies whose profits are expected to grow at an above average pace. If a company keeps this up over the long term, it gets a higher share price and investors reap big returns via capital appreciation. An investment like this does not come without risk. Therefore, you should understand the basics and know how to minimize these risks. You must be wondering how to find growth stocks worth investing in. Well, check out the methods below. A growth stock is basically a company whose profits are expected to rise at a rate that is higher than average compared to other businesses in the industry or market. Investors find these stocks appealing because the value of a company, according to Wall Street valuation, is based on several its earnings. If a company grows its profits faster, its share price will also increase quickly. But profit is not the only determinant of success. You have other things such as business model and huge market opportunities also come into play. Many high growth stock companies barely existed several decades ago. Today, however, they are household names. You have companies like Ultra Beauty, which is on the NASDAQ, Netflix on the NASDAQ, and Amazon.com on NASDAQ, for instance. They were tiny players initially, but they managed to rise to the top. How do you identify a company while it is still young? The first method is assessing your consumer habits. What services or products have you started buying recently? Did you not use them in the past? If you realize that many people are using a new service or product too much, then it is possible that the company is worth looking into. Once you identify such a product or service, perform an internet search to see the company behind it. Then keep your eye on it to see whether you have a winner. A massive change in society usually benefits most growth stocks. If a company can capitalize on these trends, they can enjoy high profit if the trend takes years. Examples of current macro trends include health and wellness. People are becoming keener about their health and lifestyles. War on cash. Transactions are going cashless globally. Companies like MasterCard and Visa will benefit from this. Increasingly, online advertising. Facebook, The Trade Desk, and HubSpot are likely to excel from the trend. The U.S. population is growing older. Companies that cater for seniors are worth investigating. See what money managers are investing in. Not all of them are worth following, but here are some well-respected ones. You have Icon Capital Management, Acre Capital Management, Dorsey Asset Management, Stock Screening Tools. Stock screeners such as Finviz will help you find growth ideas. While using them to find growth stocks, use the traits include balance sheet, sector, projected profit growth, sales growth, profitability, and market cap. The stock market is finally opening to new tech companies. Maybe a little bit, but it takes a long time from now for them to warm up to them. Groupon and Yelp are to blame for this. You can make money with tech IPOs. You only need a little common sense and be patient. And avoid listening to analysts who know little about tech. Always do your own research. Tech IPOs historically have been nothing short of disastrous. Surprisingly, even leaders like Facebook have encountered a bad IPO. Luckily, the prices have shot up dramatically. Keep an eye on Facebook. It will show you how to best approach tech company stocks. They tend to experience a colossal drop in a period of recovery. After that period, the stock can either stagnate or skyrocket. In summary, you can still make lots of money from a tech company with a poor IPO performance. Take a closer look. Facebook opened at slightly below $40 per share in 2012, and many people thought it was just overvalued. The disastrous IPO spooked investors. As a result, they missed out on the opportunity to double their cash in years. A lot of people did not realize that Facebook had not yet monetized their mobile platform. As smartphones become increasingly popular, people become addicted to a Facebook app. There were still no ads at the time. When they introduced mobile ads, the share price exploded. Facebook had such a tough quarter that Nasdaq halted trading to stop further plummeting of the share price. After all this trouble, the share price went above $210 before it took a dive. Do not cancel high growth companies before you assess the potential profit. Snapchat, unlike Facebook, has not experienced mind blowing growth in terms of profitability and user base. But still, an investor could easily and quickly double their money with it. Ever since it went public, Snap has been going through a rough patch, and it is not admirable as it once was. It started at $4.99, which was a steal. Falling was inevitable, but a few factors would have prevented a further drop in value. In a few months, it has doubled its per share price. When buying shares from a tech company that has just gone public, do so with caution. Increase your investment gradually. Alternatively, buy after it dips and sell after recovery. Twitter is not as glorious as it used to be, but it is still the envy of companies such as Snap. Twitter stock divided because of several reasons, one of them being management turmoil. Investors focused on this and forgot that Twitter does not have direct competition. They could also monetize the user base for more money. After plummeting, the stock's value doubled. And now for some more horrible stories. Groupon was extremely hyped. Despite the countless red flags, investors still bought the shares. They realized at a later date that business model was full of flaws. Groupon rushed to change their business model and shifted to a very competitive market. There was no winning after that. Zynga is another example of a company that tried to cut corners and lost. Hopefully you have learned a thing or two about investing in tech IPOs. This is the best time to buy and hold growth stocks for the next decade. The coronavirus pandemic may be scary and serious, but it will not last forever. That means that even this economic recession is temporary. After everything has passed, stocks will certainly rebound. This has happened so many times in history. The stock market has survived pandemics and many other unfortunate events. If you are a wise investor, you know that this is the best time to shop for stocks. And here are some of the best growth stocks. Shopify is on an e-commerce solutions provider. Consumers are now moving towards online shopping. The popularity of websites is rising, and people are not going to physical storefronts that much anymore. One of the websites they are shopping on is Shopify. Business owners will invest more in their online presence than physical stores. Shopify sales will increase tremendously and consequently raise Shopify revenue and profit. Facebook is a giant in the digital advertising world. It is an online interaction backbone. Instagram is the most popular app for sharing videos and photos. WhatsApp and Messenger are the most used platforms for non-SMS messaging, which a lot of people don't know is owned by Facebook. All these platforms are used by billions of users per 4 hours each day. Although ads are only on Instagram and Facebook, they are expected to be rolled out on WhatsApp and Messenger as well. It is going to be a huge e-commerce revenue stream. While still on digital advertising, here is another growth stock worth buying. The Trade Desk is a programmatic advertising leader. Programmatic advertising will become more prominent in the future. Amazon may be the biggest company compared to the rest on the list, but is an attractive growth stock just as much as any other here. People are shifting towards online shopping, and Amazon is the largest and most reliable platform for that. Consumers have been using both cable TV and streaming services because one provides something that the other does not. But Roku now offers all the content that consumers have been looking for in one place. Pinterest is an also interesting stock. Investors overlook Pinterest and that makes it more lucrative. It attracts millions of users and this number will grow. If you want to look at this more, please look at Square. It is worth looking at. People have been ditching cash payments and this trend is set to continue. Every enterprise is shifting towards the cloud, which makes Okta worth buying. People have become more environmentally and socially aware, causing them to opt for plant-based meat. As the trend gains momentum, Beyond Meat will be a big winner, seeing it as the leader in the industry. Chegg is also a prominent player in the digital education space. It offers a connected learning platform. It may become the norm for colleges and high schools in the US. Please subscribe to Financial Pro YouTube channel. See you guys next time.